Yes. So in today's class, we shall continue with our lecture on cost of capital. We've solved 2 questions already. So yeah. So I think we'll complete the third question today. After the third question, you have to go and solve others that in the question bank. You have to attempt them. You have to attempt those questions. It is very important for you to attempt those questions, please. Okay. It's not actually encouraging that I give assignments. I purposely did not even mention it again. The platform, I just stay, right? I probably did not mention it again, but it's fine. I'm going to just solve the last question, right? The first question, which is that question one. After that, you have to attend other questions. Thank you. So, cost of capital. I'm trying to check if where I have the cost of capital. Is it this? Wow, interesting. Okay, please, you have to give me some time. I think I have to restart my system. Exactly. Have to just give me some minutes. I have to restart my system. It's gonna work. Let me check these things. That's fine. I'll join you shortly, please. Thank you.
Hello?
Okay, I'm back. Please confirm. Can you see my screen?
Yes.
Yes,
Yes,
sir.
we can.
Okay, Franca, are you in this class?
Yes, sir. Good evening, sir.
Good evening. Well done. Right.
Thank you, sir.
I like your attempt. Right. Makes sense. And practice make perfection. Right. So it
Yes,
makes
sir.
sense. Like that. So make sure you practice more questions. Okay. There are so many questions that
Yes,
are
sir.
there. So just do others. Well done. Well done.
Thank you,
So
sir.
yeah, you're welcome. So we'll solve this question. Then I will close this chapter of this part of cost of capital. Then before we move forward, right? So I don't know, because most of you believe that okay, the lecture is free and you take it. Some of you take it for granted. Assignment that is being given since I'm not the one writing the exam. Since on top, is it on Tuesday?
Please, I can't see your screen,
Attempt
sir.
it. Let's see what you have. Right? Attempt the question and let's see what you have. We up to now, just one person attempt a question. Okay, makes sense. So the first required here, calculate the market value weighted average cost of capital of YK. Of course, we already know the step, right? The step that we will use to determine the weighted average cost of capital. What is the next step? Discuss how, what is the next question? Sorry. Discuss how the capital asset pricing model can be used to calculate a project-specific cost of capital. This part, you can just ignore this part, the part B of this question, because we've not done the project-specific cost of capital is like subsidiary to cost of capital, is like subtopic. When we are done with cost of capital, we'll move to the project-specific cost of capital. We've not done that yet, right? Referring in your discussion to the key concepts of systematic risk, business risk, and financial risk. I mean, I just explained the systematic risks, financial risks, and the business risks. For the purpose of this class, let me just explain, right? Then the C, discuss why the cost of equity is greater than the cost of debt. Of course, we have actually done this before at the beginning of our cost of capital, why the cost of equity is usually greater than the cost of debt. Now, the first one is the weighted average cost of capital, right? Now, YKPLC wishes to calculate its current cost of capital for use as a discount rate in investments. The cost of capital that we've been calculating, why we have to take cost of capital before investment appraisal, is because of the cost of capital. Sometimes you may need to determine the cost of capital, or the weighted average. You may need to determine the weighted average cost of capital that you will use to discount the project. And the question is now saying, okay, YK wishes to calculate its current cost of capital for the use as a what? As a discount rate. In what? In investment. We're given the financial information, right? The financial information is given, right? So what are the sources of finance here? What are the sources of finance, class?
Ordinary shares.
Ordinary shares. After ordinary shares, what
Preference
do we have?
shares.
Preference shares.
Preference shares and bonds.
Debenture.
The last one is what? What's the last one?
Bank loan.
That's bank loan. So we move forward to the next one part of it. Right. We move forward to the next part, which is the ordinary shares. Okay, now you should not forget that the sources of finance, that is the first thing that you see here, is ordinary shares. You will see that they will now talk about the ordinary shares in the what? In the story, which is the note. Now you don't know, you already know that the first thing is ordinary shares, but you don't actually know the method that you will use to determine the cost of equity. You don't know, but you know that, okay, we have ordinary shares, which is equity, but you don't know the method that you're going to use to determine the what? The costs, to determine the cost of equity, right? You don't know the method. Now, the ordinary shares of YK, the ordinary shares of YK PLC as an SDIV. So which means that the dividend has been paid, SDIV market value of 4.70 naira per share, class, which means that the dividend has been paid. And ordinary dividend of 36.3 kobo per share has been paid. They've paid this as well. Now, historic dividend payments have been as follows. Historic dividend payments have been as follows. Historic dividend payments have been as what? have been as follows. Now, look at the historic dividend. Now, looking at this now, you can see that the first thing that is in the financials is ordinary shares. They now give you the story of the ordinary shares. Now, which method are we going to use to determine the cost of equity, class? Which method are we going to use to determine the cost of equity, class?
Dividend with growth.
Dividend valuation with growth.
So we have to use the dividend valuation with what? With growth, meaning that we have to determine our growth rate. Even if we want to use the dividend valuation with growth, we have to determine the growth rate. You can see that the growth rate is not actually given in the question, right? We have to determine the growth rate. Now, the next story is on preference shares. Now, you can see that the next sources of finance here is preference shares. Then the next story in here is what? Is preference shares. Can you see how they arrange it, right? Just like the way we did in our previous class. Now, the preference shares of YKPLC are not redeemable. The preference shares of YKPLC are not what? Are not redeemable. Don't forget, they say it is not, are not what? Are not redeemable debt. It is not redeemable. Since it is not redeemable, we just have to calculate it the way it is, right? Now, the preference shares and have an SD market value. Can you see the SD market value of 40 kobo per what? Per share, meaning that the dividend of the preference shares has been paid, but it is not a redeemable preference shares. It is normal preference what? Preference share. Can you see it? That you have the SD market value. You can see that the current dividend for the preference shares is not given to us in this story. Class, how do we determine the current dividend of preference shares? How do we determine the current dividend of preference shares, class? They're supposed to include it here that this is the dividend of preference shares. They've given us the SD market value. So how do we determine the current dividend for preference shares, class?
Current preference dividend over market value as if.
That is what will give you the current dividend.
By using the percentage at the back of the nominal value.
This percentage.
We use the 4% to multiply what the nominal value.
Okay, that's fine. That makes sense. Right? That makes sense. Right? If many of you have watched the previous video, the question 1, question 2, question 3, at this stage now, you should not be having challenge if the preference shares current dividend is not given to you yet. Ideally, they're supposed to mention in that the current dividend are this, just like the way they mention ordinary shares. Just mention. Just go to your financial statement. This is 4%. That is it. It means that it is 4 kobo that they paid on the preference shares. Or it is 4 naira. Okay, it is even, I mean, it's okay, it's 4 kobo. Because when you do 4 divided by 100 times the nominal value, we give you the current dividend for preference shares. I've said it in the previous class that we did something like this. Now, the next sources of finance is what? Is this, which is redeemable bond. Now, they still give us another story that the 7% bond are redeemable at a premium, 5% to their nominal value of 100 naira per bond. Now, the 7% you see here is the interest rate on the what? On the bond. Is the interest rate on the what? On the bond. Are redeemable at, now, at are redeemable, it is a redeemable bond at a 5% premium to their nominal. So the nominal value of the redeemable bond is 100 naira per bond, is 100 naira. Now, but there is a premium, class, but there is a premium here, just like the way we did in the first class, where we have redeemable plus the premium. Don't forget, this premium, they will compensate you for the risk that you take. You have your redemption to be 100 naira. The premium is like a plus. What I will compensate you with, right? Like a plus. Right? Like a what? Like a plus to you. Premium. Just like the way we did they will pay you the principal, then including the premium. Then the premium now is at a 5% premium to their nominal value. If you want to determine the premium, it will now be 5% of the nominal value. Class, it will now be what? The 5% of their what? Of their nominal, of the what? Of the nominal value. We give you the what? The premium. Meaning that you will have a redemption of 100 naira. You will have a premium of 5% of the what? Of the nominal value. All right? I borrows Abigail 200 naira. Right? Abigail is to pay me my interest 50 naira. That is 250. I will not tell Abigail that you have to add money to it. So you have to, because of I'm taking a risk to borrow you this money. Abigail will not say, okay, no worry, I will pay you 5% of the principal amount. That is what happened here. So at the end of the day, Abigail will pay me maybe 5 naira in addition. That is 255. Is that not? So at the end, if I'm collecting my principal amount, I will add the premium because it's like a compensation for what? For the risk I took in what? For giving Abigail that particular fund. Now, and have an S interest market value. This is the S interest market value. Right? This is the S what? S interest market value. Can you see that it is S interest, meaning that the interest has been paid. Class. We've done the ordinary shares, analyze the ordinary shares, the preference shares, right? Redeemable bond. So if you want to determine the cost of redeemable bond, what are we going to use to determine the cost of redeemable bond, class?
IRR.
Internal rate of return. Now, the next story, we are done with this bond. How many years is 6 years? Can you see that it was mentioned that it is 6 years? But sometimes you have to be very careful here. Now, if the financial year is 2023, right? Is 2023, and they tell you that the redeemable bond will be redeemed in 2026. Class, if this financial is for 2023, and it was mentioned that the redeemable bond will be redeemed in 2026, you will just count from 2023 to 2026 how many years. That is the redemption period, the maturity. Right? Now, the next bank loan, can you see that we have bank loan here? Right? We have bank loan. Then, the bank loan has a variable interest rate. What is the interest rate on the bank loan? Is 4%. Right? Now, this is the bank loan. Sometimes, I've mentioned it before that any debt that is redeemable, what are you going to use to determine the the cost of the debt? Internal rate of return. Any debt at all that is redeemable, right? Any debt at all that is actually what? Redeemable, you use internal rate of what? Internal rate of return to determine the cost of that. But this bank loan is not redeemable, right? It wasn't mentioned, that the bank loan is what is actually what redeemable. Now, YK pay profit tax at annual rate of what 30% per year. That is what the tax rate. Calculate the market value weighted average cost of capital. Any whatever English they want to use. When you want to determine the weighted average cost of capital, market value will be involved, right? You will use market value. Market value will be there when you want to determine the weighted average cost of capital, right? Now, the first step. Now, I mentioned in our last class that I'm supposed to talk about book value, weighted average cost of capital. Okay, but that's fine. We'll talk about it, right? Maybe in intensive class, we can look for question on that part. Question B. Okay, suggested solution. And the thing is that I'm not. Let me just tell everyone the truth. Like, let me just tell everybody the truth now tonight, right? I'm not actually happy in this class. Why? Because I gave assignments, about 1,000 students, just one person attended the assignment, right? Before now, I have a mind of solving at least 5 questions. As the case may be now, I'm solving just 3 questions, then we move on, right? Most times we take things for granted because we see it. After all, I'm not paying for it, right? But it is what it is. It is what it is. So there's a solution.
I was not even big.
So there's a solution. So just a solution. Who is that now that is disturbing my class? I'll just remove. So just a solution, right? What is the name of the company?
YKPLC.
YKPLC. The sources of finance. Ordinary shares. The cost of equity using dividend valuation. Right. Dividend valuation method with goods. May not need to write all these things. I'm just writing it, okay? So cost of equity, D1, 1 plus good rates divided by the good rates divided by market value as the right, divided by market value as the plus the good rates, right? Where D1 is the current dividend. So what is the current dividend, class? What is the current dividend from the question? What is the current dividend? What is current dividend?
35.
36,
36.3.
36.3 kobo.
36.3 kobo. That is the current dividend that is being paid. This question is just like a trap. They probably did not include the year, right? They probably, please just mute your mic. Who is that now? So 36.3. So you can convert this kobo to naira, right? 36.3. If I want to convert it to naira, I can just divide it by 100. Do you know why I want to convert it to naira? So that you can have this market value SDV is in naira, so that you can have everything to be in naira class. So I can just divide it by 100. I don't want to write the figure so that you not say, how did I arrive at this one again? So this is how to convert. This is 37.3. 37.3 divided by 100. What do you have? 0. What?
0.363.
0.36.
363. That is 0 naira 363 kobo. That is what it means per share. Anytime you want to convert the kobo to, just convert it so that it will rhyme, because you have market value SDV to be per share. So why will you not have the current dividend to be kobo? Just convert it to shares, right? Convert it to naira, right? And by dividing it by what? By 100. Just divide it by 100, right? So what is the market value SDV of the ordinary shares? Market value SDV of the ordinary shares given to us in the question. Let's quickly go back.
4.70.
Okay, 4.70. 4.70 per share. You can see that this is per share. You can see that is the reason why you need to convert it, so that you have per share. Now, the next one is the growth rate. The growth rate is not given in this question. We need to determine the growth rate. So if you want to determine the growth rate, which method are we going to use, class? If I want to determine the growth rate of this question, growth rate, which formula am I going to use to determine the growth rate, class?
Extrapolation.
Is what? Extrapolation. So I can go back. So I can go back to my extrapolation formula, n minus 1, right? N minus 1, current dividend divided by the earliest dividend. So I can come back to this side and do my copy and paste. Where is the second one? So, and move on. Right. Okay, that's fine. So I can use what? Extrapolation to determine the growth model. Extrapolation. So therefore, if I'm using the extrapolation, I have to use, what is the current dividend given to us in this question? What is the current dividend? What is the current dividend?
35.0.
Is that the current dividend?
36.3.
36.3, right? 36.3, right? Can you see? That's why I say the question is a very
35.0.
You have to look at it. Why will you use current dividend to be 35.0? What will you call this 36.3?
That's the dividend for the year under
I can
consideration.
see the dividend for the year, 36.3.
So someone is saying is 35.0. Why? All these one are historical information. This is the current year should be 2023, but it wasn't stated. That's why I say it's a very big fact. So you should know that this dividend is for 2023. This one, why this is historical, right? Now, 36.3, 36.3. Uh, 36. I can use it here because everything is still in Kobo. 36.3 0, right? So what is the earliest dividend?
30.9.
Okay, let's check. The earliest dividend, 30.9. Thank you. 30.9. I expect everybody in this class to have this material. Okay. Oh. Then the numbers of years. What is the numbers of years? Class, what is the numbers of years?
4.
5 years.
4 years.
4 years.
Why is it
4
4
years.
years? Why is it
5
4
years.
years? What
Five
about
minus
this one?
one.
It's 5 years.
5 minus 1.
So that is 5. Who can tell me the reason why we minus 1? Why should we have to minus 1 here?
Because we
Class.
have number of years listed.
Because the
No.
reason why we have -1 is that because the last year does not have a growth rate, does not have growth. That's why we have to -1.
Thank you. Thank you. Because there is no growth in 2023 yet. If you are given the one of 2024, you can now see that from 2023, the dividend has grown to 2024. But in all this, you will see that from 30.9, it grew to 32.2, from 32.2 to 33.6, from 36.6 to 35. You can say there is growth from 2022 to 36.3. There is growth, but in 2023 to 2024, there is no growth because we're not given the information about the 2023-2024. Right? That is a very good one. Well done. So, I've explained all these things in all the videos, right? So now in this part, excuse me. So we can have 5. Please, someone should divide this. Where are my babies in this class? Are we still together? Okay, Bashira.
1%.
So I'm coming. Let's do it one after the other.
You put 5 instead of 4. 5 minus 1 should be 4.
Before someone will call me, before someone will post on the platform that how did we arrive at all these things. I'm coming. A very quick one. I know we are wasting time on this, right? But it's very important as well. Okay. So if you divide these two together, what do you have?
1.1748.
Okay. That is a very good one. 1.1748. 1748. So you do the 4th root minus 1. Just give me the final figure. What is the growth rate?
0.04.
4.1%.
0.04.
0.04.
This is 4%. So we move that the growth rate is 4%. We can say this is 0.04. Then we can now insert it in our words, in our formula here. Class. So therefore, the cost of equity, the current dividend, which is 0.3363, 0.363. The growth rate is 0.04. What is the market value SDF? 4.70. So 4.70. Right, 4.70. Should not forget that this is separate. So whichever figure you have to add it with the what? With the growth rate of 0.04. So class, what is the cost of equity?
0.1203.
0.0.12 or 12% or 12%. All right. Or what? Or 12%. So can we move ahead? The total market value. We need to determine the total market value. Total market value. The next step is to determine the total market value, right? So I don't need to bring out the formula. We already know how to determine total market value, right? So what is the value of ordinary shares? And what is the nominal value? The value of ordinary share is 4,000, right? Right?
Yes.
So it's 4,000. So what is the nominal value? 50 kobo, right?
50 kobo.
So that is 50 kobo is 0.5, right? So 4,000. 4,000. If you are wondering how we are doing it, you have to go back to the videos. 0.5, right? If you divide it by 100, if you divide the 50 kobo by 100, right? 0.5. My God. Okay. Times, what is the market value?
4.70.
4.70. So what is the total market value?
37,600. 37,600.
20.
37,600.
37,600. We should not forget that is a million, right? It's a
Yeah.
million. You can just put it like this. Now, what is the net sources of finance, class? What is the net sources of finance?
Preference
What is the
shares.
net source? Preference shares. Preference shares. Preference shares is the net sources of finance. But we're told that preference shares is not redeemable, right? Who is that one again now? Please, can you mute your mic? Right? Preference shares. We're told, class, don't forget that even if the preference shares is redeemable, you will use internal rate of return to determine the cost of preference shares. Please take note of that, but it is not redeemable. So what is the formula for calculating preference shares? Class, what is the formula for calculating cost of preference shares is equals to what, class?
Dividend
Dividend over market.
over market price. X
That's
dividend.
Preference shares dividend.
Market price X dividend.
Current dividend of preference shares
Over market value SDIF.
Thank you. Current dividend of preference shares. I probably put it like this, or no. Before you go and use the dividend for ordinary shares and put it and say it is current dividend of preference shares divided by the market value SDIF. Don't forget how to convert. Don't forget how to convert the COMDIF, just like the way we did in the first class. You see that video? Go up. See that first one. So market value as div. If it is cum div, you have to determine your market value what? Market value as div. Now, the current dividend for preference shares, current dividend. In that in that story, they were supposed to give us that the current dividend for preference shares so is this so amount. So, but it wasn't stated. And I said that if it is not stated, just come here. Don't stress yourself too much. Just come here. Pick 4%. Do 4 divided by 100. What is the nominal value? Multiply by the nominal value. The nominal value is 1. We give you the current dividend for preference shares. Right? We give you the current dividend for preference shares divided by 100 times the nominal value of 1 naira. So what do we have here?
0.04.
0.04.
04.
So the market value as div for preference share is given to us, right? Is given to us. What is the market value of preference shares? S div. Market value S div for preference 40 kobo. So let's just convert that. Let's just convert that 40 kobo to naira because this is in naira already, right? So let's just convert it to naira. Let's just divide it, right? So that you have 0.4, right? Is this 0.4?
Correct.
Okay, that's fine. Can you see why I have to just convert it? Do you know why? Because you have current dividend to be in naira. Divide it by naira. Is that not so? Please. It's very important, please. Right? So, cost of preference shares equals to 0.04 divided by 0.4 times 100. What do you have? What is the cost of preference shares?
10%.
10%. That is 0.1. So the total market value, total market value is equals to, what is the value of preference shares given to us in this question? What is the value of preference shares?
3,000.
3,000. This is the value of preference shares divided by the nominal value. We have the numbers of shares times the market value as the of the preference shares. So we have 3,000 divided by the nominal value to be 1 times the market value of the preference shares, 0.4 naira per share. So what do we have here?
1.2 million.
What 1.2 million, because it's a million there, right? That's a very good one. So the next, what is the next sources of finance? What is the next sources of finance, class? Redeemable bond. Redeemable bond. So what is, so if it is redeemable bond, what are we going to use to determine the cost of the redeemable bond? What are we going to use to? We use internal rates. We use internal rate of return. Kudus, what happened now? What happened?
Okay, I have an observation. The market value, we are already using 1,000 and we are putting the total answer in million.
Anyone that you want to do is still the same thing.
Okay, just for other people that will watching the video.
They should know now. They will know that this is in million already. Is it not 3 million? It's 3 million. You want us to put 3 million? Okay, now. This part to be 3 million or so, 4 million. So what are the ingredients you need when you want to determine the redeemable bond? What are the ingredients you need? What are the ingredients?
And the market value, the
Market value
interest,
what? Market value what?
XD,
X,
XD,
X
SDIV.
interest. X interest.
Market
X interest. X interest. X interest.
Um, uh, Tina, please mute your mic. Tina. Anna.
Yes, sir.
So what are the ingredients? Please, what are the ingredients?
You said the market value X interest,
I said, okay.
sir.
See, Ojo, I said, oh yeah, market value as what?
X interest.
After that, what do we have again?
Then tax
Number of years.
relief.
Just mute your mic, don't worry.
Interest.
So we have
relief.
the S interest, interest, tax relief interest, number of years, and redemption.
Numbers of years.
Years and redemption.
Redemption. Please, you can mute your mic, please. Thank you. So the market value of redeemable bond, a market value as interest is
Interest premium.
104. Okay, 104. Okay, thank you for that. 104.50. Can you see it? 104.50, right? 104.50 per bond. There is premium. There is premium. So we need to add the redemption and the premium together, right? So market value S interest. What is the market value S interest? 104 point what?
0.5.
0.5 per bond. Then what is the interest rate on the bond? What is the interest rate on the bond?
7 naira.
10 naira.
Okay, how did you arrive at your 10 naira? What is the interest rate on the bond? Is it not 7 naira?
7 naira.
7%.
7%, right?
Yes.
So we need to convert it to naira. So we can have 7 divided by 100 times what, class? 7 divided by
Times the nominal value.
Thank you, nominal value. So this will give 7 naira. Then there will be a tax relief. That is why the cost of debt usually lower. So how many percent is the tax rate?
30%.
30%.
30 divided by 100 times the interest rate. What do we have?
Two point one.
2.1. 2.1. And I said that you can also use, if you don't want to use this one, right? If you don't want to use this, I gave the formula even when we are doing the analysis. Then you can use interest, or you use interest open bracket 1 minus tax rate if you minus 7, you know, tax relief on interest will reduce the interest rate. If you say 7 minus 2.1, you have your answer. If you do interest 1 minus tax rate, you have the final answer. Whichever one you want to use, you will still have the same thing. So what is the numbers of years? What is the numbers of years, class? What is the numbers of years?
6.
6
5
years.
years.
5 years.
6 years.
5
5
years.
years. It's 5
5
years.
years.
Well, where did you arrive at? How did you?
Yes.
God. How did you see? Where did you see 5 years? This is
6
after
years. 6 years. 6 years. 6 years.
Okay. Now, in another case scenario, where if this financial year is 2023, then they will now tell you in this redeemable bond that it will be redeemed in 2026. Just count from 2023 of this financial year to the 2026, right? To the 2026, we give you what? We give you the numbers of years. When you are, this financial year is for 2023, it wasn't mentioned, right? Then they will not state here that the redeemable bond is redeemed to be redeemed at in what? In 2026. Just count from the date of this financial year to the redemption period. We give you the numbers of years. So in this question, we're given to be 6 years. So 6. So the redemption, which is the nominal value, is 100. Don't forget that there is premium. It means that at the end of the 6 years, when I take back my principal, you will still pay me premium. Class, you will still do what? You will still pay me premium. That is the principal, the nominal, the redemption, plus what? The premium. So what did they say about the premium? Class, what did they say about the premium?
5%.
5%.
5% to what? 5%.
So they are not
5% to their nominal value, right? 5%. So 5 divided by 100 times the nominal value. So what do we have?
we have
5
5.
naira.
5 naira. So we'll pay back the principal now, right? The principal will not be only the 100 naira. You will still add 5 naira to me because you will compensate me for the risk I took in borrowing you that fund. That is what it means. So we have to use internal rate of return. So let me quickly copy what we have right here in the previous. I'll just copy this. So we'll just quickly do try and error. Right. Let me copy this quickly. Internal rate of return. Internal rate of return. So what is the market value as interest in this question? What is the interest?
104.5.
104.5. So what is the interest?
7 naira.
7 naira.
7 naira. So what is the tax relief?
2.1.
2.1. Right. So we have the numbers of years to be 6. This is 6. This is 6. At the end, you pay my redemption plus the premium.
Premium 5.
105.
105.
105. Thank you. So I can have plus 5 plus 5. So 105. Right. So what do we have here? So you have to do the annuity. Check annuity figure 1 to 6 when the DCF is 2%. The lower the DCF, right, the higher the MPV. Quickly, class, what is the annuity? From year 1 to 6. What do we have? Quickly, class, what do we have? One to 6. Do we have anyone in this class that did not know how to calculate annuity? Do we have? Hello? Okay. What happened now? Kudus? Okay.
Yes, sir. Yes, sir.
Okay. I never see figure. Only yes, sir. The year
5.60, sir.
coming.
5.601.
Coming.
5.6014.
Negative. This will be 10%. So what do we have for the, okay, this will be 104.5. Next, what do we have here?
5.601.
For the DCF, what is the DCF?
For the redemption, 0.89.
0.89. 89 what?
Okay, the 0.888.
0.880.
888.
0.888. So what do we have here as the annuity?
5.601.
5.601.
5.601. That is too much. That is too high, but that's fine. 5.60 what?
1.
Is correct. 5.601.
Okay, 5.600. 5.601. So that's fine. 5.601. Okay, it's for 6 years. Okay, that's fine. So what do we have? Multiply quickly, so that we can move, please.
39.207.
39.21.
39.7. Big.
39.207.
21. 39.21.
39.21. Next.
11.76.
11.76. Then what do we have here?
93.24.
93 point what?
24.
0.24. So I can put this naira sign up here. Don't mind me. This naira sign where they disturb me like this, I can just put it up. but that's fine, Sha. You can always amend, right? So what do we have here? What is the positive MPV?
16.19.
16.19. So the next one, what do we have here? Under the 10%. Under the 10%, what do you have?
$4.355.
4.355. Next, what do you have here?
For the redemption, 0.564.
0.564.
5. Round it up.
4.
5. Round it up now.
That is 4 now.
What is this?
0.5645.
The next, what do you have here? Okay, the same thing is 4.355. So when you multiply the first one, what do you have?
30.49.
30.49. 30.49. Next, what do you have?
9.15.
Okay, 9.15.
59.22.
This one 4.5. Okay, 59.2.
59.2.
That's fine. Thank you. So what do we have? What is the negative MPV?
Minus 23.94.
Okay, that's fine. 23.94 negative. All right, so I can come here and just copy my formula for calculating internal rate of return. I can just come here and copy this. Okay. So the lower rate is 2. All right. The lower rate is what? Is 2. Positive MPV 16.19. Positive MPV 16.919. Negative MPV 23.94. Then the higher rate 10 minus 2. So what do we have here? What is the costs? Let's break it down one after the other. Right. This is 8, right? You divide this, right? You divide this first, right? Then you multiply by 8, then you now add 2. So what do we have?
21.5.
21.15.
21.5.
0.5%. Is that correct? Or 22%? Is it correct? Please confirm. Are we good? So what is the total market value? Total market value total market value. How do we determine the total market value, class? What is the what is the value of redeemable? The value of redeemable bond is 3 million, and the nominal value is 100. So we go back. Total market value is 3 million divided by the nominal value times the market value as interest 0.5 per bond. Kudus, she is correct, right? The
The IRR, I don't know. What I have is 5.23%.
IRR is 5.23.
5.23%.
23.
5.23%.
5.23%.
2%.
The person that gave me this figure, how did you arrive at your figure?
It was a mistake. I've gotten it now. 5.23% now.
That's fine. What do we have here? The total market value. What do we have here?
I have a 3,135,000.
3,135,000. So after this, we move to the weighted average cost of capital. Weighted average cost of capital. There are two formulas for it, though. That is why I say let's just keep the second formula. When we get to the second part of cost of capital, we'll unveil that one.
What about the bank loan, sir?
Okay,
The bank
thank
loan,
you.
sir.
Okay, thank you. Bank loan. Bank loan. The cost of bank loan, thank you, equals to interest, open brackets, 1 minus tax rate, after November diets, when you see your results. In fact, many of you will want to travel to, we want to come to Abuja to come and see next gen team, because by that time we'll have done a very good job, right? I'm saying it because I know what I'm saying. There's no center you want to go in your physical that they will break it down like this, as we did in the way we started cost of capital. I'm saying it that many of you that believe in next gen, we want to, like IB, we want to see the team, right? I said that I mentioned that last diet, and some who think it is not possible, they saw the results, right? It is not magic, right? It is efforts. Everybody, you have to put in efforts, right? Giving you assignments to do does not mean that I will come to the class and do it again. It is for you to test your knowledge on that particular word, on that particular topic, right? So what is the interest rate of on the bank loan?
4%.
So we have 4%, 1 minus tax rate. What is the tax rate? 0.3, right? So what do we have?
2.8%, sir.
2.8%. Or you can make it 3% or 2%. So what is the total market value for bank loan? What will be the market value of the bank loan, class? What will be the market value of the bank loan?
The
1
nominal
million.
You say? Kudus.
Nominal value.
will be the total market value. 100 naira will be the total market value.
1
For bank loan,
million.
1 million.
1
Right, well done.
million.
Thank you. Well done, Kudus. Right. That shows that you are paying attention to every video you go back and watch. You are paying attention to details. You are not just watching because you want to rewatch. You are paying attention to it. We have said it maybe under the cost of debt. He said you cannot, bank loan is non-traded debt unless if it is mentioned otherwise in the question that, oh, bank loan is redeemable, before you now say, oh, you need to use internal rate of return, right? You need to do what? Now, bank loan here is not redeemable. You cannot determine the market value of bank loan. Therefore, because it is non-traded debt, therefore, the figure given to you in the financial statement, right? In the financial statement is the what? Is the what?
1 million.
Is the market value of the bond, which is what? Of the bank loan, which is 1 million. So let's quickly move to the weighted average cost of capital. The market value weighted average cost of capital. The question can even, they can tell you, calculate market value weighted average cost of capital, calculate post-tax weighted average cost of capital. If it is market value, if it is post-tax, it is still the same thing, right? It is still your normal weighted average cost of capital, unless if they change it that calculate the book value weight, you now know that book value is different. It's just like book value is just like historical costs, right? Historical cost. Why market value is the current market value. Can you see that they are two different things, right? Right. I'll check for question on that, but it's nothing. It's nothing to be worried about, right? So items. The total market value. The costs of capital. Franca, did you get it to this part? Franca. Okay. Okay. Ash total. Ordinary shares. Which is, we use the dividend valuation method to determine the costs, right? A minute, please, sir. Okay, so ordinary shares, which we use the dividend valuation method to determine the cost of the what? Of the equity, right? So I will need figure here. So what is the ordinary shares? What is the total market value of the ordinary shares?
37 million.
600,000.
Away 600,000. Someone say 37 million. Someone say 600,000. I'm confused.
37 million 600,000.
37,600,000.
Okay, 600,000. So what is the cost?
0.12.
21%. Just give me the percentage.
12%. 0.12.
12%.
Oh, okay. Me, it's too much Gary. You know, when you drink Gary too much.
Please,
Next,
sir.
see this guy, it's saying good. Okay. Okay. So the next one is what?
That's preference share.
Preference shares.
So what is the market value for preference shares?
1.2.
1.2 million. So what is the percentage?
10%.
10%.
0.1. The next one is what? Redeemable bond. Person tell me, someone said redeemable. Nibo. Okay. 3135. This is 5%. Redeemable, right? Bank loan. So this is 3%. 0.03. So what do we have here? When you multiply, someone should just total the market value, total market value.
So Ash
512,000.
Okay. Barakat, are you?
No,
Are you?
I'm
Are you?
referring to the ash total for the ordinary shares.
Okay. Bashira, sorry. Bashira, so you are in this class. Then you didn't do my assignment.
I'm sorry, sir. I will do better.
That's fine. So what is the total, please? The total market value.
What is 2,935,000?
945,000.
35, 935, 945, 935.
Okay.
935,000.
So next.
the Ash total.
I beg, give me the
Ordinary
total.
share.
Wait, give me the total value. What is the total ash total? Okay, you have it. Okay, don't worry. What do you have here?
4,512, 4,512.
4,512,000.
4,512,000. So what do we have here?
120,000.
120. Don't forget that there are two formulas for this 120,000. There are two formulas for calculating weighted average. We'll unveil the second formula in the second part of cost of capital, which is the subtopic. The name that is project specific cost of capital. Right. I know we'll spend much time here, right? But hopefully maybe middle of August, right? Or towards the end, I think we should be able to round up on cost of capital. You should not forget that this takes about how many percent of the syllabus? I think about 20% of the syllabus. This cost of capital is as important as anything. If you don't understand cost of capital in FM, please don't even bother to go and write the exam. Please. I'm saying it because I know what I'm saying, right? And some of you will take it as joke. Why now? Maybe I have working capital. They play. Maybe you have a business valuation. They play. If you don't understand cost of capital, you can't do business. Because what you will use in business valuation, you will still use weighted average cost of capital. So if you don't understand weighted average cost of capital, you should not even bother. That you say, if you don't even understand cost of capital, don't even bother to go and write exam. FM. It's just like SFM. Imagine someone wants to write SFM and you did not understand cost of capital in SFM. The person should just sleep. Because there's nothing you will mention today, even in FM, that they will not tell you to calculate either cost of equity or cost of debt, or weighted average cost of capital. So what do we have here?
That one is 150, 750. 156, 750.
156.
750.
750.
Next, what do you have?
30,000.
30,000. So what is the formula for calculating weighted average cost of capital?
30,000.
So what is the total?
Total 4,818,750.
4,810,000.
So weighted average cost of capital is equals to cash total divided by the 42,935. Please mute your mic. Oh. What do you have?
11%.
0.11. 11%.
Nice.
Or 11%.
11%.
No, tactical. I think I've tried when it comes to this cost of capital stuff, right? You should be able to solve question now on cost of capital, right? So it is what it is, class. It is what it is. 11%. Okay. Do you have anyone that have question before we look at before we just discuss this? Then we'll go, please. Oh shit! I think okay. Do you have anyone that have question? Okay, we are good. So the B part of this question says that you should discuss how the capital asset pricing model can be used to calculate project specific cost of capital. This is another part of cost of capital. We'll get there, right? Hopefully next week we should start this project specific cost of capital, right? Is another part of cost of capital, and I believe I know you will still enjoy the class because it's practicable, right? Then the next thing is
Please,
what is systematic?
Please, under that,
I can't hear you.
can you hear me now, sir?
I can hear you now. I think your network, I can't hear you. I can't hear you at all.
Remove my earpiece. Can you hear me now, sir?
Yes.
Okay. Under this our preference share that we got total market value of 1.2 million. But in the question for preference share, the market value, this 3,000 divided by 1, it will give us 3,000, right?
Yes.
Times 4. But somebody said it's
It's 40
1.2
kobo.
million.
Is it not 40 kobo? 40 divided by 100. That's 0.04. I don't know. Now give me figure now. So is the figure that you gave to me, is it not 0.4? Is 0.4?
What about this 4% preference share? I thought that's what we need to use.
Why will you use that now, Babalola?
4.4 now.
Why will you use the listing first? Why will you use the one of dividend? Have you forgotten how we normally calculate total market value? Please, you can go back to the previous this thing and check, please. Thank you.
Something here. Okay.
So, by referring to
Sorry. Please, can you scroll down a bit so that I can get the IIR total value?
I'm coming. I'll
3 million.
finish
Yeah.
there. So the next concept here is determine using the project specific cost of capital, right? That one is another part of cost of capital. Then we have systematic risk. Friday.
Good evening, sir.
Good evening.
Sir, I noticed that in our previous class, we were minusing outstanding dividend. So this class, we did not do that by calculating preference share. So please, I want to understand, when do we minus our outstanding dividend?
Have you been following our classes from the beginning?
Yes, sir.
Did you watch the first class? The first question we did in class under cost of capital?
No, when I joined was when we were solving the KKPSC. So I'm using that one to make reference.
No. Just go back. Go and watch you. You will know the reason why we have to do that, please. Thank you. Now, systematic risk. The question is, what is systematic risk? And before I move to, I don't know. Okay, let's just move first. Systematic risk, right? What we are doing at Next Gen, if you look at the way we deliver the lecture, and if we decide that in the city of FCT now that we want to do these things in physical class, that okay, our price is this, people will come for the class and pay. Now, most of us now see this as it is just an avenue for all the professionals, right? Prospective professionals to take their career forward by leveraging on this advantage, because it is free in these diets. I said it, I mentioned it last diet, right? That it is free for now. It may not be tomorrow. Why can't we sacrifice? Why can't we pay the price now? Right? So anyone that want to ask, if you know that the question you want to ask, you are not there from the beginning, just quickly go back and check everything you need to know. Everything, I can say it anywhere. Everything you need to know under cost of capital has been explained. Everything, I can say it anywhere. Everything. It might interest you to know that some other people are sitting down on the YouTube and using my notes to form their own notes. Like, I don't know them. They are using it to form. They are not even part of our students. They are using it to take other classes. That is how valuable it is. So please, we are all professionals. Take advantage. Take advantage. Right? I'm the one taking you FM today, this diet. I may not even have the time to take next diet. Right? So many things could happen. So many things, right? Now, systematic risk. Systematic risk is what we call unavoidable risk. It is what? Unavoidable risk. You can't avoid it. A practical illustration is the inflation rate, the exchange rate, the unemployment right? And other factors. You cannot, it is uncontrollable by a company. It is affecting everybody. The cost of data is affecting everybody. The inflation rate is affecting everybody, all the businesses. That is systematic risk. This could be 2 marks, this could be 3 marks. And someone will now be saying it in his or her mind that, how did you know? Okay, don't worry. When you see it like that, you will remember that IB mentioned in class that this thing may be 2 marks or maybe 3 marks. Then, business risk. What is business risk? Business risk are risks that affect a specific line of a business. It is specific. A practical illustration is the CBN recapitalization policy today. It's affected the financial institution positively, right? The new reform of insurance, you can see all the insurance companies are running enter-scatter. They want to meet up with the minimum capital base, affecting that one to strengthen their liquidity. And by extension, create employment opportunity because they need more people to come in. And you could see some merger and acquisition. Or we have already seen, we have been seeing the indication already. Now that one is, by the way, that I'm just using that to explain that this is business risk. Why? The financial risk. Any risk that affects a business not to achieve its stated objective, a particular line of a business risk. Why we have what we call financial risk. This financial risk is only tailored to a particular company. It's a risk that affects an individual company. Maybe the risk of high level of gearing, inability to pay back, inability to pay their suppliers and when due, inability to meet up, or yes, to pay back their loans, right? That is financial risk. It is only affecting AA. It is not affecting BB, right? Now, discuss why cost of equity. So, can someone just tell us why cost of equity is greater than the cost of debt before we go? Can someone explain?
Cost of equity has higher investment risk
You
than
don't wait,
cost
Basirat, wait. Someone said something. So he said what?
Equity does not involve removal of tax relief on equity like debt compared to debt.
That's fine. Bashirat, that's fine.
I should go ahead.
Yes, please.
Cost of equity involves higher investment risk than cost of debt.
Okay, that's fine. Makes sense. That's fine. You're in there.
The cost of equity is greater than the cost of debt because equity investors take on more risk than debt holders. So basically, they require a higher return to compensate their risk.
So which other things can we look at?
There is no tax relief when it comes to cost of equity.
Daddy.
Mommy.
During liquidation, they are the last people to be paid.
Thank you. Babalola.
Equity holder will go for dividend, for increase in capital, for capital appreciation.
Okay. Why debt holder we go for what?
Go for the return and their
Is
principal.
interest now. Is interest.
Interest and principal, yes.
Is interest. Is interest. That's fine. That's fine. So thank you so much, everyone. You guys have. So on the.
So please,
Let me
can
just
you
scroll down.
scroll down on your screen, please?
Check on YouTube now. Now they always they stress me. Oh.
Sorry, sir.
This night, now don't stress me too much because I'm not even not the way I usually deliver lecture now. So
Hello, sir. Sir, you said you are solving 3 questions today, but this is one. Let's continue.
No.
Hello, sir. I want to apologize on behalf of my classmate.
Leslie is fine.
For no.
Thank God. Your network is not good.
For not doing it.
Thank God your network is not good.
Please.
Okay.
Please let me just IIR part, please.
You can only check it on.
Sorry, sir.
Just check the. No, that's fine. That's fine. So thank you so much, everyone, for joining, and I have other questions here for you to go and go and attend to the question. Remember that we cannot.
Sorry, sir.
We have this question 4 here. There's also question 5.
Sorry, sir.
There is question 6. You have a lot of questions here, so make sure you attend to them. All right, so it is what it is. That is what I have to say. It is what it is. So thank you so much, everyone. And any other person, are we good? So we are good to go, right? So thank you so much, everyone, for joining, and enjoy the rest of your day. Thank you.
Thank you, sir. God bless you, sir.
Thank you, everyone. Thank you.
Sir, we love you.